Hi guys, good evening again. Okay, this evening we are going to look at the accounting equation. All right, and it is also known as the balance sheet equation. Now they're both the same, but this evening we are going to focus mainly on the accounting equation. Yes, we are going to do the balance sheet equation to show you why they are both basically the same, but because you all are beginners, we are going to focus on one at a time. So we are going to look at the accounting equation this evening. As I said, it's not going to be much, it isn't going to be much theory. We are going to put in some figures to play with your mind, okay? And yeah, we'll see how enjoyable it's going to be in the end. I hope you all enjoyed this session. So let's get started. Okay, so the accounting equation. Right. So the accounting equation is the basis of accounting. Well, it is the foundation of accounting. All right. It shows the relationship between assets, liabilities, and capital. Now, I know that you all are not familiar with assets, liabilities, and capital. So I have indicated to you what I've given you a definition of each of these, all right, that you can refer to. All right. The accounting equation, when you change one component of the accounting equation, you can come up with other components. So for instance, if it is you want to find assets, we know that assets equals liabilities plus owner's equity. If you want to find liabilities, you can come up with another equation. If you want to find capital, you can come up with another equation. This evening, we are going to focus on the basic equation. Assets equals liabilities plus owner's equity. So that is what I mean. If it is you change one component, then automatically the other components will change. So the formula basically shows that the assets of the firm are either purchased by its liabilities, meaning that when you borrow money from the bank or either a friend, then you owe these people. So it's a liability. And sometimes when people borrow money, it is for them to purchase maybe an item. For instance, if it is you want to buy a piece of furniture for your business, then you may borrow money from the bank in order for you to purchase that furniture for your business. All right. So really and truly, you would literally borrow money to buy certain furnitures for the business, as well as the owner can use his own capital, his savings, to purchase these same furnitures. He has a choice. He can borrow it, or he can use his own savings, which is known as his capital he would have invested into the business. So I'm going to just show you these components are expressed in the form of an equation. So we are going to deal with the basic equation, just a minute. Right. Okay, so we are going to focus mainly on the first equation there. Assets equal liabilities, add owner's equity. So I said to you before, from this equation, you can find out what is liabilities. If you want to find liabilities, you can, as you can see below there, I have the equation for liabilities. If you want to find out what is owner's equity, you can use that equation that I have listed below there. But this evening, we are going to focus on the main or the basic equation, which is assets equals liabilities add owner's equity. So of course, you will have these other equations looking at you, but we are focusing this evening on assets equal liability plus owner's equity. Let's move on. Right. Okay, so if you all are hearing me, just give me a thumbs up, please. Okay, great. So we're looking at the components or the elements of the accounting equation. So it is what is there? What do you find in the accounting equation? You find assets, and have given you a definition as to what are assets. Assets are things of value owned by a business because they bring future economic benefits to the business. So when you have assets in a business, it is not for it to just lie there and accumulate dust. It is for you to work those assets in order for you to bring in profits into the business. They are acquired for a business to carry out its day-to-day activities. So that's what assets are. They are acquired to carry out day-to-day activities. Examples of assets, I have given you some here. Office equipment. When you think of office equipment, think of furniture, think of the computer, think about the computer table, the filing cabinet. All of those are office equipment. And then you have another example of asset, which is stock, which is, of course, I've put it in bracket there for you, unsold goods, which the business normally deals in with the intention of reselling. So these are the goods that the business will have for resale. And then you have debtors. And I've given you a definition as to what are debtors. A person or organization who owes money to the business for goods or services, supplies, okay? And then you have cash. Now, all of these are assets, but I have broken it down even further to tell you exactly these assets, what category it falls into. So assets can be classified into fixed assets and current assets. So when you think of fixed assets, they are used for the business operation to generate income. We've just spoken about that. They are purchased for long-term use in the business and are not likely to be sold for cash within a year. So fixed assets are more or less the furniture that a business will purchase. They are not going to purchase these fixed assets for resale. They will purchase it to stay in the business for years. Maybe, of course, it has to be over 1 year, 2 years, 3 years, 5 years, 10 years, it depends. All right. So fixed assets, those are examples of fixed assets: furniture, office equipment, computer, land, building, etc. And then we have current assets, assets that can be converted into cash during a financial year. So these current assets are assets that you can more or less convert into cash within a year. All right, it doesn't go beyond a year. You can convert these current assets into cash quickly. All right, and I've given you example: stock, debtors, cash in hand, cash at bank. Those are all current assets. And then we have liabilities. Liabilities are amounts owed by the business to other parties. So the moment you hear of liabilities, think of the business owing a third party, someone else. So liabilities are all the people or businesses that a business owes. Once the business owes money to a third party, it's a liability. Again, liabilities are classified into long-term liability and current liability. So let's go through quickly and see what are long-term liabilities. They represent a debt or amount owed to an individual or firm. The repayment is no longer than 1 year. Oh, sorry. The repayment is longer. I said no longer. It is longer than 1 year. So long-term liabilities are for like over a year. It could be a year, 2 years, 3 years, 5 years, 10 years. And I've given you an example of a long-term liability, and this is just one name I'm going to use for you. You are going to come across it in accounting: debentures. Debentures are long-term loan that are lent to a business, all right? And usually it's like for about 10 years, okay? But it could be 5 years as well. So long-term loans are monies, more or less, that are going to be owing for loans that are given on a long-term basis. Then we have current liabilities, which represent a debt or an amount owed to an individual or firm, which must be paid within 12 months of creation. So when you look at a current liability, look at a liability that will more or less exist only for 1 year. It is not beyond a year. Anything that is beyond a year, it is referred to as a long-term liability. A current liability is for 1 year. All right, and I have given you a definition of current liabilities. We have creditors, which is a person or organization to whom money is owed for goods or services. All right. We have also as well bank overdraft, which is a facility offered by the bank allowing customers to withdraw more money out of their account than they have deposited. So if it is a business has, for instance, $10,000 in the bank, that's their saving, $10,000 in the bank, and they need to get, let's just say, $15,000. Now, although they do not have $15,000 in the bank, they have only 10, the bank would lend the 15,000, and that extra 5,000 that would be added or given to that business to make that $15,000 loan, that 5,000 is known as the overdraft. You have gone over what you actually have in your account. Okay, so we're going to move on. And then we have capital. Capital, also known as owner's equity. Be familiar with these two names because you will come across it regularly. Some of the textbooks will just use the name owner's equity. Some will use capital. They both mean the same. And it means one's own or borrowed money invested in a business to generate income. So if an owner invests money into his business and it's his money that he has more or less invested in the business, he is investing that money so that he can make profit. Okay, income is a form of profit. It is profit. All right, so we're going to continue. All right, so I have indicated here that this is a question for you to identify assets, liabilities, and capital. All right. We are going to just identify these based on the information I have just given you there. And I want for you to tell me, I'm going to just give you 10 minutes just for you to tell me what are assets, all right? And if possible, you can mark for me if it is, if an item is a fixed asset or current asset, all right? Or if an item is capital, all right? So 10 minutes just to do that. Okay, so guys, we are going to look at our answers. Okay, for those of you who have not finished, once I've given the answer, you can go back and just double check, all right, and make sure your answers are in fact correct. So A, motor vehicles are fixed assets. All right. B, shop fittings are fixed assets. And for those of you who don't know what are shop fittings are things like shelves or any kind of installation that has to be made in a business. All right. Shelves, if it is that they need to probably refurbish or install anything new in the business, all that is referred to as shop fittings. So obviously that is going to be there for a while and it is referred to as a fixed asset. Okay. C, cash at bank, it's a current asset. D, amounts owing to suppliers. These are monies that are owing to suppliers, and that is current liability. Once you are owing money to a supplier, someone who you have purchased goods from, it's a liability. You are owing that person for the goods that you have purchased. So D, your answer is current liability. E, capital or owner's equity is always a liability. Capital is a liability. I remember when we did accounting concepts, we spoke about separate entity, and you must be able to differentiate between the owner and the business. So it's like the business is owing the owner. Try and internalize what I'm saying here. The business is owing the owner, and that is why it's a liability. Okay? Capital is never an asset. Okay? Don't make that error at all. F, stock is a current asset. G, bank overdraft. We spoke about bank overdraft just now. It's a current liability. All right. If it is you have borrowed money in excess of what you have in your account, you have to pay back that within a year. All right, so it's a current liability. The bank will not allow you to take excess money for a long period of time, okay? So it's a current liability. And then we have H, creditors. Creditors is a current liability. Machinery is a fixed asset. You think of any machine you want to put in your business, it is not for resale, so it is a fixed asset. J, furniture. If you purchase furniture for your business, it is a fixed asset. K, loan from a friend. It depends on how long the friend is going to lend you the loan for. If the friend is going to lend you the loan for 1 year, it's a current liability. If the friend wants to be lenient with you and say, look, listen, you can pay back the loan in 5 years, it's a long-term liability. Okay, so it depends on how long the friend is going to be lending you the loan for. If it's for 1 year, it's a current liability. If it's beyond a year, it is a long-term liability. And then L, cash in hand, is a current asset. And then we have amounts owed by customers. So the business is being owed money, and that is, we refer to that as debtor. Anytime anybody is owing a business, they are a debtor to that business, all right? And that is a current asset. And the last one, debtors, is a current asset. I hope that was pretty straightforward and you all would have gotten a grasp of it better. All right, so, oh, nice. Kadeen. Okay, so Kadeen, you got one wrong. So it means that you have a good understanding. Great. Most welcome, Siobhan. Most welcome. All right, so we are going to continue because we now have to get to the accounting equation. All right, and I think this is mainly our lesson today, to understand how the accounting equation works. So I'm going to go through it with you guys now. Okay. All right, so since I'm going to be explaining, okay, guys. All right, so you are to complete the columns, of course, with assets, liabilities, capital. And this was an exercise that I prepared for you to do because I did not want to confuse you. I've decided to do the exercise with you and explain it as we go along. Okay, so after this, you wouldn't be guessing. You will know how to apply this accounting equation. All right, you would know how to apply the components here to the accounting equation based on the transaction. Now, as I said, it is the basic accounting equation that is used. Assets equal liabilities plus owner's equity. This is one of the basics. We are going to look at the equation, and based on the transactions that are given. All right, so let's start with A. This is a transaction that occurred in the business. The business bought a motor van on credit, $5,000 from sudden sales. Let's try and understand what our transaction is. Okay, the business bought a motor van on credit, $5,000 from sudden sales. So we are seeing three things here. We are seeing where the business got a motor van. We are also seeing that the motor van was bought on credit, so it's a liability. And we are seeing as well that it didn't have any effect on owner's equity. So let's see. So the asset there is motor van. So the reason for you putting the plus in front of motor van is because the business got a motor van. It is an asset to the business, okay? The business received that motor van, $5,000. The motor van cost $5,000. They received that motor van. So it is going to be an asset to the business. However, it's a liability to Southern Sales because Southern Sales sold the business this motor van on credit. So if it is no money was passed, if no money was passed or no money was paid for the motor van, then it's on credit. So it means that sometime in the future, you will have to pay for that motor van. All right? Does it affect owner's equity? Does it have any effect at all on owner's equity? No. Usually it's these accounting equations will affect two components, okay? We'll come across more in the future, but for now, we are dealing with just about two. All right, so the business received the motor van. The motor van costs $5,000. It is an asset, so it is a plus for the business. The creditor, which is Southern Sale, the business, or Southern Sale sold the motor van to the business on credit. The Southern Sales did not receive any money for the motor van as yet, so the business is owing Southern Sales. So it's a plus for Southern Sales because they know that they have to get money. All right, so it increases the liability for Southern Sales, and that is the reason for you having a plus both by assets and liabilities. Once it does not affect owner's equity, you just put no effect. All right, let's go to B. The business made loan payments to First Citizen Bank, $1,000 cash. Let's see how we can break it up. We are seeing that this transaction involves First Citizen Bank loan the business $1,000, and of course the business is paying that $1,000. Okay, so it's a loan payment. So I guess there are many other loan payments, but this is one loan payment that the business is making to First Citizen Bank. So if it is the business paid First Citizen Bank $1,000 cash, then $1,000 cash is going to be coming out of the business because it's a payment. So if you look on the asset, cash is an asset, it's a current asset. And of course, $1,000 is leaving the business. So you put a minus in front of that $1,000 to indicate that money is leaving the business. As well as with the liabilities, if you look at the loan that First Citizen Bank lent to the business, First Citizen Bank has to also take out that $1,000. So let's just say First Citizen Bank is supposed to get back $10,000 loan. This is one of the payment that would have been made, one payment. Each time the business makes a payment, they have to deduct it. You are reducing the liability. So First Citizen Bank is reducing the liability. If it was $10,000, the business was owing to First Citizen Bank, the business will now, of course, reduce the cash. And of course, First Citizen Bank is also going to reduce the liability. okay, because a payment was made. All right. The third one, the business paid A. Ali, a creditor, by check $1,500. Again, the business paid. Look for the key words, paid. As in B, you see there was a payment. Once that payment was made, it can either be cash. If they have recorded cash, you can put cash. Every time you see check, you are associated with the bank. So you can put your asset there as being bank, okay? Because the business paid K. Ali, a creditor, by check. Each time you see check, just name it bank. If you put cash, you are not going to be penalized. So you could put either bank or cash, but be familiar with every time you see a transaction by cash, put cash. If you see a transaction that was paid by check, put bank, okay? Because you associate banks with checks, all right? So in this case, K. Ali got paid. So if it is the business paid K. Ali, then K. Ali's cash is going to be reduced, or the bank amount, the amount in the bank is going to be reduced because the business paid K. Ali, okay? And of course, the creditor, Ali, K. Ali is the creditor. So you will have to reduce K. Ali as well because he's no longer owing that 1,005. Okay, he's no longer owing that 1,005. So you have to minus that 1,005 as well from the creditor, K. Ali. All right. If it is, you all are following me so far. If you all are following me so far with those three that I have done, just indicate, give me a little feedback as to whether you're confused. All right, continuing. Continuing. Okay, Kadeen, I will have to go through that with you again. You'll have to tell me where your confusion is taking place. All right, it's going to become easier. Don't worry, it's an introduction to accounting, so you will understand as time goes by. Okay, Kadeen, I'm going to make note of your name so I can get back to you. Right, let's move on. Moving on to D. The owner, C. Smith, puts $5,000 cash into the business. So if it is the owner decided that he is going to pay the business, because the owner and the business are two separate entities. So the business received $5,000 cash. All right. So obviously, the cash is going to increase because the owner puts $5,000 into the business. And by extension, because he has increased his capital by $5,000, you would show as well that his capital has been increased by $5,000. So for instance, if the owner had put, let's just say, $20,000 as capital into his business, and he came after and he put $5,000 more, then it means that his capital is now going to be $25,000. So you are showing under assets where the business received $5,000 from the owner. And of course, the owner's capital is also going to be increased by $5,000. Hence the reason for the reason for the 2+ signs you're seeing under assets and owner's equity. Okay, hope that is clear. E, sold goods on credit to J. Graham, $800. Now, you have to understand that accounting equation doesn't have to affect the three components. It doesn't have to affect assets, and it must affect liabilities, or it must affect owner's equity. It can affect only one component, like letter E there, E. E, it shows where this transaction only it affected only the assets. It didn't affect liabilities. It didn't affect owner's equity. So let's understand what has happened here. Sold goods on credit to J. Graham, $800. So the business sold goods to J. Graham, $800 on credit. So if it is the business sold goods to J. Graham, then the business stock is going to reduce because the business sold goods to J. Graham. The stock is leaving the business. So you have a minus 800 because goods leaving the business, all right? It is being sent to J. Graham, okay? And of course, because J. Graham got those goods on credit, it means that J. Graham has to pay for those goods. So you are going to put a plus, meaning that the business is going to await the payment from J. Graham. So the business has recognized that the J. Graham has to pay that $800. So the business recognized that $800 already as an income for the business. Again, let me just go through that part. You notice where it has affected only the assets of the business. Sold goods on credit to J. Graham. Goods are leaving the business. So you minus that $800 because the goods are leaving the business. It's going to J. Graham. So it lessens your stock. But it also increases your debtor. Debtors are people who owe the business. J. Graham is owing the business $800. So the business will now put in their books where J. Graham is owing the business. So in time to come, J. Graham, which is of course within a year, all right, it takes about maybe 60 to 90 days for you to pay your debt, all right, which is 3 months. So J. Graham has to pay the business $800 within a 30, 60, or 90-day period. Certainly not over a year. Okay. And now we are going to F. Bought goods on credit from M. John, $2,200. If you bought goods, just focus on the fact that you have bought goods. So it means that goods are coming into the business. Goods are coming into the business. So it's going to be a plus for stock. It's going to be an increase for stock. So it's a plus 2,200 because goods came into the business. So you bought goods, goods is coming into the business. It is a $2,200 increase in stock, okay, for the business. All right. Now the goods was bought on credit. So because the business is owing M. John, if the business is owing a third party, it's a creditor. If the business is owing John $2,200 for goods that he supplied to the business, then of course the business has to pay John, the creditor, within 30 to 60 or 90 days. Okay, certainly not over a year. So you are going to indicate that this credit here, this creditor, the business has to record M. John as a creditor, someone that the business has to pay. The business has to pay M. John. Okay, so you have to put it as a plus, all right, because it was on credit. No money was paid out yet to John, and that is why it is still a plus. Okay, if money was paid to John, then you're going to see a minus 2002, but it was on credit, no money was paid, so it stays at a plus $2,200 as a credit. Okay, guys, moving on. Okay, we are looking at G. The owner, C. Smith, takes out $1,000 cash from his business for personal use. When you see a transaction like that, it is referred to as drawings. Drawings. So if it is the owner takes out $1,000 cash from his business, he ought not to do that, but he can, all right? Obviously, it's going to reduce his cash because in the business, of course, because he took out $1,000 cash. So under asset, you will put cash, $1,000, because he took out cash. And under the owner's equity section or the capital section, you're going to put a minus $1,000 as well, because the owner's capital is no longer, as we used the example just now, we say $20,000. So if it is the owner takes out $1,000, oh, sorry, we came up to 25,000. If the owner takes out $1,000 cash, he reduces his capital or his owner's equity. So his owner's equity will now be $24,000. Okay, he took out money from the business. Remember the separate entity. The business is one person who is separate from his business. So he is more or less taking out $1,000 from his business. So you're going to show where the $1,000 is taken out from his business. Okay. H. The business paid a creditor, C-Can, $1,900 by check. The business paid a creditor, C-Can, $1,900 by check. Every time I say you see the word check, think of bank. So we're going to show where assets, which is a current asset, bank is a current asset. We are going to show where the business paid from the bank account to C-Can $1,900 cash, or sorry, by check. So that reduces the business bank account because they paid C-Can by check. So you will have a minus in front of that bank. And of course, under liabilities, C-Can has to also reduce the amount that the business is owing him. He cannot leave his liabilities as $1,900 owing to him by the business. It has to be reduced because the business paid by check. So you minus your creditor, C-Can, $1,900. And I, we're going to I now. A debtor, M. Thomas, paid the business by cash. So a debtor is someone who owes the business money. So if the business is being paid by M. Thomas, the business is in fact receiving money. So we put a plus in front of cash because M. Thomas received $1,200. So since the business is receiving that $1,200 cash, you put a plus. It is a plus for the business. They receive money from M. Thomas. But remember, since M. Thomas paid the business, you have to reduce M. Thomas' debt as well. M. Thomas is no longer owing the business. So you have to show M. Thomas, who is a debtor, as a minus, okay? Because M. Thomas paid. So you have to show M. Thomas as a minus. All right, hope that part is clear. And the last one, L. Singh lends the business cash $4,000. All right, it means that maybe L. Singh is a friend of the business. He lent the business $4,000. So the business received $4,000 from L. Singh. So the cash in the business is going to increase because the business received $4,000 cash. All right, but no mention was made about the business paying back Singh his money that he has lent them. So the business is still owing L. Singh that money. Although you see in the cash there, you have to try and read the transaction and understand what it says. L. Singh lends the business cash $4,000. So we saw where the business received $4,000 cash, but we didn't see that the business paid back L. Singh any money. So because the business is owing L. Singh, he is a creditor for $4,000. It's a liability because the business owes, the business owes L. Singh $4,000. All right. So I hope it's clear. Let me get some feedback. Okay, guys. Okay, it seems as if most of you understood. All right, so since that is the case, beautiful, nice. Okay, all right. Great, so here's what. Let us try the exercise, and I guess with the exercise that I'm going to give you now, you will have a better understanding. Just read your transaction and ask yourself, did the business receive cash? Did the business pay money? Is the goods or is whatever transaction on credit? Is it a loan? Ask yourself questions as you read the transaction, and it will help you as to how do you identify which component in the accounting equation is being affected. Okay, so let's go straight to the exercise. Okay, let me just tell. Okay, so guys, I'm going to give you all 20 minutes. This is a simple exercise. I know you all would have a little problem with G. I will explain it, all right? But give it a shot, try it, and then we are going to correct it. You have just about 20 minutes so that we can take 10 minutes to correct, okay? Okay, guys, so let us just correct your exercise, all right? And after this, I'll just take whatever questions you have, okay? So, A, we pay a creditor in cash $700. Because you have paid cash, it means that the cash in the business is going to be reduced. So you have to put minus $700 cash. And of course, we pay cash to a creditor. because the creditor is the person or the third party who the business is owing, you have to reduce the amount of money you are owing to the creditor as well. So under creditor or liability, sorry, you're going to put minus $700. Okay? So under assets, you're going to have minus $700, and you could put cash in brackets. And under liabilities, you have minus $700, and you could put creditor in brackets. All right. So I'm just waiting for you to make whatever changes before we go to B. Okay, so for A, minus $700 cash. Okay, because cash is an asset. It's a current asset. $700 is leaving the business, minus 700. Of course, because you're no longer owing the creditor, you minus the 700 as well for the creditor. B, bought fixtures paying by check, $2,000. Now remember, I told you fixtures are like any kind of installation of furniture or whatever it is for the business. It could be an AC as well that you would have purchased that is considered a fixture. And it's, of course, it's a fixed asset. So you bought fixtures paying by check, $2,000. So if it is you bought that fixture and you are paying by check, then your bank account is going to be reduced. So under asset, you have to put minus $2,000 because the bank amount is going to be reduced. And of course, because you are receiving that fixture for the business, because you bought it, it is an asset, it is a fixed asset for the business. You have to put under asset as well, put plus $2,000. It is an asset for the business. So under asset, you will have those two items. So under asset, you're going to put minus $2,000, which is what you would have paid for the fixtures. And of course, the business is receiving a fixture. So you put, it's a plus for the business, you add $2,000. That is B. It doesn't have any effect on liabilities. It doesn't have any effect on the owner. So you could put dash under those respective components or columns. C, bought goods on credit, $2,750. If it is you bought goods, obviously your stock is going to be increased because you bought goods. So that's a plus for the business. So under asset, you're going to put a plus $2,750, and you could put stock in color. It shows that goods came into the business received those goods. All right. And of course, because it was bought on credit, it wasn't paid for, it means you have to now record that creditor. You are owing that creditor. So you need to put a plus because no payment was made. You are still owing that creditor. You put $2,750 under liabilities. Liabilities are people who the business owes. Okay? It doesn't have any effect on the owner, so you can put a dash. All right. So that is C. You're putting a plus under asset, $2,750. And under liabilities, you're putting a plus $2,750 as well. You could put in brackets under asset stock. Under liabilities, you could put in brackets creditor. All right. D, the proprietor introduces another $5,000 cash into the firm. So The owner is the proprietor. He brings in another $5,000 into his business. So cash is going to be increased for the business. So under asset, you're going to have a plus 5,000 because cash is coming into the business. The owner brings in, or he has more cash coming into the business. And of course, because the business and the owner are two separate entities, you are going to show where the owner's capital is $5,000. So under asset, you have $5,000 cash that came into the business. So that's a plus 5,000. And of course, the owner's capital is going to be increased by $5,000. So that's a plus for the owner, $5,000 capital. You could use the word capital or owner's equity. They both mean the same. All right, there is no effect on the liabilities, so just put a dash. E, J Walker lends the firm cash $2,000. If J Walker, lends the business $2,000 cash, then of course the business received that cash, so it's a plus for the business. So under asset, which is a current asset, $2,000 cash, okay, plus $2,000 under asset, and you could put cash in column. And because the business did not pay J Walker is a liability. He lent a loan to the business. All right, so the business is owing J Walker. So you're going to put a plus as well under liability because that money was not paid. If it was paid, then you put a minus, but it was not paid, so you put a plus. And you can put in bracket loan or creditor, whichever word you want to use there. For F, a debtor pays us by check $500. F, a debtor pays us by check $500. Us there means the business. Us means the business. So let us rephrase it. A debtor pays the business by check. They can use the term, they can say us meaning the business. So a debtor pays the business by check $500. So because the business received a check for $500, you're going to put, the moment you see bank, you see check, you put bank, which is a plus $500 because the business received that $500 from a debtor. All right. And of course, it's an asset. Bank is a current asset. And of course, you have to indicate as well where the debtor is no longer owing the business. So you're going to put debtor minus $500 because you have to reduce the amount that the debtor is owing the business. All right. So for F, you're going to put under asset only plus 500 for bank and minus 500 for debtor. It doesn't have any effect on liabilities nor owner's equity. For G, we return goods costing $600 to a supplier whose bill we had not paid. All right. So if it is you are returning goods to the supplier, all right, it means that the goods is leaving the business. You are returning it to the supplier. So you're going to, your stock is going to be reduced. So under asset, you put a minus $600 because you are returning the goods to the supplier. So you're going to put a minus 600 and you could put stock in brackets. to indicate that your stock is going to be reduced by $600. And of course, if it is you reduced your stock or you return your stock to the supplier, you are no longer owing the supplier. So you have to indicate where you are going to minus that $600 from the supplier who is a creditor. Suppliers are creditors. So because you are no longer owing the supplier, you have to show where you have to take out that $600 from there. You are no longer owing him because you returned his goods to him. Okay? So under assets, you're going to put minus $600, and under liabilities, you're going to put minus $600. So you could put in bracket under assets, minus $600, you could put stock, and under liabilities, you put minus $600 creditor. A creditor is, well, a supplier is considered a creditor. It doesn't have any effect on owner's equity. And H, I hope that part was clear. H, bought additional shop premises paying by check. So whatever shop fittings, I should have used the term there, shop fittings, but let's just say shop fittings. If you bought additional shop fittings paying by check, it means that that's an asset for the business. It is a fixed asset that you have purchased for the business. So obviously that would be a plus on the asset. All right, shop premises, or you could even put shop fittings. The premises would be whatever it is, whatever you would have purchased for the business. So your asset there would be $50,000, a plus $50,000 because the business received shop premises, okay? And of course, the business paid for those shop premises by check. So the bank is going to be reduced. So under asset again, bank being a current liability, bank is going to be reduced by $50,000 as well because the bank paid by check. All right. So we have completed that exercise there. Maybe I should just call it out quickly. Oh, guys, I am realizing that we don't have time, but the last thing I want to be able to show you all, the question you should ask yourself, why is this accounting equation important? Here is what I want you all to do for me. Because the second one is an easier exercise for you, I want you to add and minus all of the transactions from A to H. Under your assets, I want you to add and minus what you see there. All right. And you should come up with a figure, $8,450. That is when you add and you minus everything under your assets. I want you to do the same thing for your liabilities. Add and minus everything that you have seen under liabilities. All of your minus and your plus, I want you to apply it on your calculator. You should come up with $3,450. And of course, you're going to go to owner's equity and you're going to add and minus everything that you see under owner's equity, and that would be just $5,000. Now, when you apply the accounting equation, you have on one side of the equation assets, which is $8,450. I call that figure for you. Your liabilities is equal to $3,450, and your owner's equity is $5,000. If you look at the equation, assets is equal to liabilities plus owner's equity. If your assets is 8,450, and you look at the other side of the equation and you see your liabilities plus owner's equity, your liabilities being 3,450 plus your owner's equity, which is 5,000, will give you your asset figure 8,450. So your accounting equation has balanced. Okay, and that is as simple as it is. Now we're going to continue this next day, and we are going to do the balance sheet, because the accounting equation is like the balance sheet, and I will show you how to apply these components in the balance sheet to show balance. Okay, so that's it for today. I really hope you all would have understood, if not everything, at least most of it. Go through it again. Remember, accounting is about practicing and analyzing in your mind what exactly a transaction is telling you. Once you're able to read and analyze and understand, you would be able to apply. Okay, so next day we are going to do the balance sheet equation. All right, and we'll see how much more we can put in there. Okay, have a wonderful evening, guys, and bye-bye.